Verizon and AT&T are the two largest telecom providers in the United States when measured by overall revenue. Of course, T-Mobile is trying to catch up in a third place finish. But which one of these two, Verizon or AT&T, is the better stock to buy now? I'm going to answer that question by comparing these two on revenue growth, on cash flow from operations, and then looking at their forward price to earnings ratio, and finally looking at a discounted cash flow valuation model for each Verizon and AT&T to finally come to the conclusion on which one I think is the better dividend stock to buy. Interestingly, I'm not too interested in what the dividend yield is in determining which one is the better dividend stock to buy, and I'll explain why that's the case during the video. So let's get into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing I wanted to compare these two on is revenue growth. And you can see that revenue growth has been flat for a long time. And there has been some volatility within the businesses due to acquisitions and divestitures. But the core business is not growing. And that's difficult. It's difficult to manage a business that's not growing, that doesn't have any growth prospects. The markets that Verizon and AT&T operate in are mature. There aren't very many new customers entering. And so it's a battle within each other to keep and retain the existing customers while trying to attract any new customers that enter the market as the younger population ages into the category when they want to have a wireless account. What's also pressuring growth for Verizon and AT&T is that people are keeping their smartphones longer. They're not replacing their smartphones, and typically that's an occasion for Verizon and AT&T to generate revenue growth through the sale of a smartphone, through an upgrade, through a sale of accessories. It's an opportunity, and if people are not upgrading their phones as often as usual, that's fewer opportunities for Verizon and AT to generate incremental revenue growth at the margin. I highlighted that the dividend yield is not a major contributing factor in my decision for which one is the better dividend stock to buy, which might sound counterintuitive. Verizon offers a dividend yield of 6.65% and AT&T at 4.5%. And the reason why the dividend yield is not a major contributing factor for me is because as a dividend stock investor, you're exposed to the change in the stock price. And the change in the stock price could be so large that it can offset the difference in dividend yield. And so, yes, the dividend yield is something that I consider, but overall, I look at the potential for the stock price to increase, or at the very least, not decrease. And so the dividend yield can be more sustainable for companies that are generating sufficient cash flow and sufficient profitability. And so the dividend yield, while I do consider it, while I do look at it, I'm not too concerned about the difference here, Verizon at 6.6 and AT&T at 4.5. The cash flow from operations to sales is an important metric for Verizon and AT&T because the companies have so much debt as well. Each of these companies have well over $125 billion in debt. They are two of the most indebted companies in the world. And so cash flow from operations is that much more important when you have that much debt, because you have to service that debt and you have to maintain good prospects in order for lenders to be interested in refinancing that debt if you need to refinance when those principal sums come due, and also attracting lower interest rates. The higher your cash flow from operations to sales, the more comfortable lenders are lending you money and the lower interest rates they would be willing to offer. So this is a vitally important metric for these two. Verizon generates 27% cash flow from operations to sales, and you notice it's been on a downtrend since 2020. Whereas AT&T, not only does it have a better cash flow from operations to sales at 31%, but it's been improving this metric over the last decade, up from around 20%. So both improving it and better than Verizon. All right, so finally, let's compare valuation. AT&T is trading at a forward price to earnings of 11 compared to Verizon, which is trading at a forward price to earnings of 8. So AT&T is considerably more expensive than Verizon stock when measuring by the forward price to earnings ratio. But that's only one method of valuing a business. Another way I look at a business is by doing a discounted cash flow model. And my DCF for AT&T brought me to an intrinsic value per share of $21 when the current market price is 24. So this signals that it's slightly overvalued according to this valuation method. Similarly, I did a discounted cash flow model for Verizon, and my intrinsic value per share for Verizon came to $40.74 compared to $40.53 for its current market price. So my DCF for Verizon leads me to believe that Verizon is fairly valued, whereas the DCF for AT&T leads me to believe that it's slightly overvalued. So looking at the prospects of these businesses, they are very similar. They operate in similar markets with similar strategies, and they both face difficulty with their growth prospects. The big difference between these two is the valuation, with AT&T being considerably more expensive than Verizon. Now, while I did see some outperformance by AT&T, most notably the CFO to sales compared to Verizon, I didn't see enough of an outperformance from AT&T to justify this much of a premium valuation over Verizon. So if I had to pick between these two dividend stocks, my choice would be Verizon. Although I will say I would not want to own either of these two stocks because of their lack of growth prospects. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.